Hello, good afternoon. My name is Sarah Hare and welcome to our latest webinar in connection with our FTSE 100 ETF. Boris, Brexit and the FTSE 100. Just a little bit of usual housekeeping before we start. A recording of the session and a copy of the slides will be sent to all registrants by the end of the day. Also, on the right-hand side, there is a widget that allows you to ask questions and interact during the session. Our host will also be answering questions, so please feel free to ask throughout the session. Some important information, again, before we start. Everything contained in this webinar is general information. We don't take into account any personal circumstances, and before you make any investment decision, please consult your finance professional. Right. On to our speakers for today. David Bassanese, I'm sure most of you are familiar with, our Chief Economist. We're also joined today by Alistair, our Account Manager, Portfolio Analysis and Advisor Business, and a POM, English, yeah, from the mother country. So just before we do get started, we've got a few polls. We always like to know what you're thinking on the topic and how you're interested. So do you think the UK will have a hard or soft Brexit? Some pretty tough talking going currently. Wow, okay. I would say a strong sort of consensus there. And just to gauge any other people like Alistair around the room. How familiar are you with the UK? So, are you from the UK? Your parents from the UK? What's the familiarity there? Okay. All right. Excellent. Now, we do like to show what you've all thought. Everyone's, well, 80%, roughly picking that hard Brexit. I like the optimism of the 18%, and just to see, there we go, it's on the other side, so 70% and 30%, roughly from the UK. Okay, let's get down to business, and without any further ado, I will pass to David Bassanese to start us on the webinar.
Thanks very much, Sarah, and thanks everyone for joining us today for what I think is a pretty exciting new product, adding to our suite of international exposures, getting some specific country exposures now. So I'm going to spend the first part of this presentation looking at the UK outlook, and obviously with all the Brexit uncertainty surrounding the situation there. Then I will hand over to my colleague Alistair, who will talk more specifically about the FTSE index and then the BetaShares fund. And as you'll see, one of the points will find it interesting is that the UK does have some challenges, obviously, but the FTSE index is actually a little bit different from the UK economy. So I think that's one of the key things you'll find a bit later that Alistair will go into. But let's get straight into it in terms of the economic outlook. So here's just a chart of UK GDP. And as you can see, as with many countries, they had a recession back during the global financial crisis. But since then, growth has actually been pretty good. Been running just over 2%. It's slowed more recently, certainly in more recent years. And as you can see there, the March quarter number was actually pretty strong. So the year-on-year number was up about 2%. Now, that's the good news. And part of that was stock building, and so inventory run-up was pretty strong in the quarter, which was seen as, I guess, precautionary pre-Brexit inventory building by businesses, ahead of some potential dislocation later this year. The Q2 GDP number does come out on Friday, and the market's expecting a close to flat result, so quite a slow number, and some are actually suggesting a negative result. So, let's not mince words. I mean, there is a risk of a UK downturn, even a UK recession with Brexit, but I'll go into some of the arguments for and against that as we proceed. Just in terms, I mean, the other, I guess, important point is this is relative unemployment rates in the UK and the Eurozone. And again, with that good economic growth since the GFC, we've had declining unemployment. And as you can see, one of the features of the UK economy is that it has typically got a better performing labour market than we see across most of Europe, with an unemployment rate considerably lower. In fact, as of now, it's still just under 4%, whereas in the Eurozone, it's up around, in the high sevens. So if the UK does have a downturn, it's starting from a position where, it's actually close to being fully employed, and the Reserve Bank, the Bank of England, was actually thinking about raising rates given the previous strength in the economy. And I think that's just to bear this in mind. I mean, the Brexit decision was 3 years ago now, and the economy, amidst all that uncertainty, has actually continued to grow, and the unemployment rate has continued to decline despite all that uncertainty. So again, that potentially does bode well for the economy, over the coming year, given, all this uncertainty we've had so far. It hasn't been enough to cause, business to rein in their horns, stop employment, stop investment. So what about the nearer term outlook? So obviously Brexit looms large, and now with the new UK Prime Minister Boris Johnson, I mean, he has now promised to leave the EU with a deal or no deal on October 31. So that is now the current official deadline or the official divorce date, unless there is an agreement between the UK and the EU to extend that date, which has already been extended once. The UK will formally, no longer be part of the EU after October 31. So the question is, will they be able to strike a deal to smooth the transition? Because without a deal, basically UK will revert to what's called most favoured nation status under World Trade Organization arrangements. So they'll still it'll face some tariffs from the EU. And there'll be some new regulatory hurdles in terms of services, trade and whatnot. So it does potentially open up a can of worms if no deal is able to be achieved. What we do know is the EU have said that they will not renegotiate the deal. Meanwhile, you've got the UK Parliament saying they can't agree to a deal, but they also don't want no deal. And there's question marks over whether or not the Parliament itself will be able to block a no deal, somehow be able to block the UK leaving without a deal in place. But again, we just have to wait and see on that. And I guess, for those that don't know, the key sticking point here is what's called the Irish backstop. Once the UK does leave, it means that Northern Ireland, as it's part of the UK, would no longer be part of the EU, whereas the Irish Republic, the southern part of Ireland, would remain part of in the EU. So without anything else, you need to have some customs checks at the border. So you need to have now physical border infrastructure in place between those two parts of Ireland, which many don't want to have happen because it may lead to renewed tensions in Ireland. So want to avoid that, but they haven't been able to agree. The deal that Theresa May came up effectively kept the UK and particularly Northern Ireland within the EU customs union for the foreseeable future until they could agree at some point later to a deal that would mean they wouldn't have to have a physical barrier. But again, the rest of the Parliament, Boris Johnson, didn't like that because it basically, even though it's Brexit, the UK would still remain part of the EU customs union. That was the issue with the Irish backstop. So that is the key sticking point. Seems to be, if there is a hard Brexit, it seems that there would now be some physical barriers between Northern Ireland and the Irish Republic, but we'll just have to wait and see on how that pans out. So bottom line, high uncertainty in that there is I guess a standoff between the EU and Boris Johnson, and I guess at this stage it does seem like as the polls suggest, a hard exit seems more likely than a soft exit with a negotiated plan. So how has this affected business? Just some charts here. So first one is the manufacturing order book. So it's an indicator of the health of the UK manufacturing sector. This is a long-run series going back to the late 1970s, and as you can see, I guess the reference point is what we saw during the GFC, where that index did drop to about -40. As you can see, in the last few months, again with that, with the as that deadline looms, as the uncertainty has become more, I guess, heightened, you have had a reasonably sharp drop-off in the manufacturing order book in the UK. So that is a worrying indicator. Not quite yet at the GFC levels, but nonetheless at that level, it would be consistent with certainly contraction within the UK manufacturing sector, if not the broader economy. If you look at some other indicators, the leading economic index has also turned down, and I guess one way I measure that is the percent decline from its previous high. And as you can see, it has certainly come off. Not at the levels we've seen during past recessions, so it's still, touch or go as to whether or not it's weak enough to suggest a recession. But certainly there has been a downturn in business sentiment and heightened uncertainty, particularly in the last few months. Another indicator of that is, again, a survey, a Deloitte CFO survey. This is from a Bank of England study that shows that the percent of businesses suggesting that there is a lot of high uncertainty is very high in the UK, or certainly higher in the UK than it is in the rest of the G7, so developed countries outside of the UK. So the blue line versus the purple line in that first chart. And if you look at the second chart, which is actually business investment, you can see that investment has been rising since the GFC, whereas in the UK it's been quite weak for a while. But again, I guess one point there is that has been a feature, it has been weak for the last few years, so it's been hurting the growth outlook. So again, one of the risks here is that you could see a bigger contraction in business investment of the like that we saw during the GFC, but at this stage it hasn't happened. But again, that is one of the worrying points. Final point, another, I guess, estimate of that of the deal versus no deal. This is a forecast from the UK government itself, actually, the Office of National Statistics, and showing that it projects that if there is no deal between the UK and the EU, that would be the worst case outcome for the economy, according to these economists, of course. And that is the cumulative deviation in GDP relative to a baseline, or without anything else happening, over 15 years. So 9.3% looks pretty bad. That is over 15 years. So it's effectively about, it's basically saying growth would be 0.5% weaker per year over the next 15 years than would otherwise be the case. So look, that's how the economists are seeing it. Just to dig a little bit deeper into that. I get the issue. I mean, one thing is that people have said, oh, okay, even if the UK leave the EU without a deal, they would fall to World Trade Organization trading arrangements with regard to tariffs, and the fact that the EU doesn't impose very high tariffs on the rest of the world would mean the UK effectively wouldn't be subject to very high tariffs. So that's the good news. So manufactured exports, for example, would face a tariff of about 3%. In agriculture, though, it will be a little bit trickier. So the UK agricultural sector does face challenges because the EU's tariffs in that area is something like 20%, so significantly higher. And the other issue is there's a lot of non-tariff barriers, which are very hard to quantify, the impact on trade. But again, the analysis here from the UK government itself suggests non-tariff barriers are worth something like 6 to 15% for goods and 4 to 18% on services. So again, no deal are potentially barriers that's a quantification of the cost for UK exports. So it's that, and again, this is one of the challenging parts of this whole debate about the Brexit, is that the biggest cost potentially to the UK is in these non-tariff regulatory areas, which again are very hard to quantify in terms of how quickly will businesses be able to adapt to new rules and still be able to trade. I mean, the fact remains that the UK, China, everyone else outside of the EU still is able to trade pretty well with the EU. So obviously businesses outside of the EU have managed to deal with, whatever barriers are in place, whatever regulatory issues the EU impose, and still be able to trade pretty well with Europe at the moment. So that's why I think, this issue about Brexit, you do need to allow, there's a high uncertainty as to whether it will be a really bad thing or not such a bad thing, because a lot of these potential issues are very hard to quantify. And there is some good news. So it's not all doom and gloom, and this is just a take, again, from a Bank of England survey about the degree to which businesses have done some planning for Brexit. So again, any business worth its salt, any business that is doing trade with the EU would obviously be looking very carefully and has had 3 years to do so, look very carefully at the various rules and regulations that they would face under various scenarios and have made some planning provisions. So something like 3/4 of the firms have done some form of contingency planning in the event in advance of the Brexit. So that potentially does bode well for the economy. Some other issue, also some positives, is that the government is obviously preparing for the Brexit as well. There's, again, Boris Johnson has outlined major fiscal stimulus programs, infrastructure spending like hospital rebuilding, new railway links to the northern cities, income tax cuts, increased schools funding, more for all this. But basically the bottom line here is fiscal stimulus to help support the economy if need be over the coming year or so. And also there are, again, any government worth its salt would be doing this, would be doing major contingency planning for different scenarios, post-Brexit scenarios. And so they're bolstering their border and customs operations. In terms of medicines, there's been because a lot of medicine does come in from the EU, so there is concern that there may be, at least a temporary interruptions in that supply. So they've been stockpiling important medical and drugs and whatnot as well, and support. And the other interesting thing that, again, this is more a longer term issue, that Boris Johnson has talked about his plans for free ports. So parts of the UK, certainly coastal towns, for example, that would become special tariff-free zones where trade into and out of those areas wouldn't be subject to any tariffs. And so, it's potentially setting up the UK pretty well down the track. And the last but not least is the fact that the currency, the British pound, has weakened certainly over the last few years on the back of this Brexit uncertainty. And so this is, in terms of the companies doing business offshore, it's helping boost the pound value of their offshore earnings. So that's a positive for listed companies, but also for the economy more broadly, to the extent, there are tariff barriers or there's new barriers for exports. The fact the pound is getting cheaper and exports are more competitive, does bode well. I just conclude on a couple of points. There was an interesting article in the AFR a couple of days ago from a fellow called Adrian Blundell-Wignall, who I respect a lot. He is a former senior Reserve Bank official. He spent many years at the OECD in Paris, where I did used to work. I actually worked with him many years ago. But I thought it was interesting, his article basically saying that he thinks the Brexit will be a good thing for the UK, and he sees a lot of potential for that economy once it kind of extricates itself from the more slower growing EU region, the regulatory burdens that Europe does face. And I actually do agree with that. I think, longer term, even if there is some short-term pain, the UK economy could set itself up very well in terms of new trade agreements, a more deregulatory system than, say, the rest of the EU longer term. And potentially, if businesses have planned pretty well for a no-deal Brexit, I mean, it could almost be a Y2K type event. I'm not saying that it would be, but if we all remember Y2K, the turn of the century, we all feared all our computers would implode once the clock ticked over to January 1, 2000. It turned out nothing really happened. And so I just wonder, come November 1 in the UK, the day after Brexit, whether or not, we'll immediately see how the economy is functioning. So it could just be, things actually hold up pretty well. And I think, that would be, I think the economy is actually going to hold up pretty well. Probably the trickiest time for the economy will be over the next couple of months as that uncertainty intensifies. But thereafter, I think it's set up to do pretty well. And I actually think, again, longer term, over the next 1 to 2 years, the FTSE index and the UK economy could be, one of the great buying opportunities. And I'm not just saying that because we've launched a fund. We've got 50-odd funds. I personally do believe that the UK will be better outside of the EU once it manages this transition period. With that, I'll hand over to my colleague Alistair, who'll talk in a bit more detail about the FTSE index and why it's not necessarily the UK economy, and some more details on our actual ETF.
Yeah, thanks, David. And probably outside of Brexit concerns, the main issue at the moment is probably the ashes going forward.
I didn't mention that.
Got my mind on other things, but no, I'll be looking at a little bit under the hood at the actual FTSE 100 index itself. As David mentioned, if you actually look at it's not just UK-centric companies within the FTSE 100. You'll see that in that left-hand pie chart there, whilst a lot of these companies are based in the UK, when you look at the breakdown of their revenues, it's only 28.9% of their primary revenues coming from within the UK. Compare that to the chart on the right, the US market, the S&P 500 in particular, 70% of their revenues are coming from domestic sources. So in terms of a country in itself and an index, it's really a global index. Actually looking at the EU and exposure there, according to numbers from Goldman Sachs, only 17% of UK sales have come from the European Union historically. So these global companies may have some cushion from the Brexit fallout if it goes ahead, and really focus on global trade. Just actually looking at performance over the longer term, the trend with the MSCI World for the broader international market has been fairly in line. However, more recently, and David covered some of this in the economics, there has been a lagging of UK equities. Since around 2013, that really started to come into the fray. Actually translating that into valuations, when you look at this on a price-to-book level, the UK is sitting at a significant discount to its international peers, potentially presenting a good buying opportunity in terms of pure value. It's important to note that not all of this has come from Brexit. If you break down the sectors within the index, if the market, 70% of the market's exposed to global multinationals in areas such as healthcare, industrials, energy, materials. All of these sectors themselves have seen significant downward pressure on their valuations. As a result, you would expect something like this to be happening in the chart. Just looking into those sectors a bit further, particularly for Australian investors, the FTSE 100 could offer a real good diversifying opportunity. It's underweight compared to the Aussie market, areas such as financials and property, whilst giving an overweight to consumer staples and energy. When you look at this in comparison to some of the US equities that many investors have in their portfolios already, combining the three can give a really nice diversified portfolio across multiple sectors. Importantly as well for many investors is dividend yield and income. Now the FTSE 100 historically has offered attractive dividend yields, currently very similar to the Australian market, significantly above its global peers of the MSCI World. At the time of launch of this fund, mid-July, the 12-month trailing index yield was 4.8%. So very, very competitive there. Now just looking at the fund itself, the new BetaShares FTSE 100 ETF. The fund itself provides investors a very easy way to access the 100 largest companies listed on the London Stock Exchange in a single trade. The first of its kind in Australia, investors can purchase it through on the ASX using the ticker F100. It's important to note as well, it is an unhedged exposure. So buying those UK companies, you will also get exposure to the fluctuations in the pound relative to the Australian dollar. But actually looking under the hood, for a management fee of 0.45%, you're getting access to global names, as we've discussed, names such as Shell, BP, Diageo, Unilever, HSBC, companies within that energy, healthcare, consumer staples, and large financial companies. Just like any ETF, fully transparent, highly liquid, bought and sold on the exchange using the ticker F100.
Okay, great. Thanks, Alistair. So just again, some things to consider before we take some questions. If you want to shoot those through, there's obviously been a lot discussed. So please consider investment risk. Investments can go down as well as up. And as Alistair mentioned, this is an unhedged exposure, so currency risk with international investments. No guarantees. Again, outcomes are uncertain. This is general information only, and seek professional advice before making any investment decision. All information is available on our website. Please consult the PDF for more information. So, just before we take some questions. So the first up is, how important is trade with the EU for the UK? So, England?
I can just, in terms of exports, so I've got some numbers here. Look, it's fair to say it is pretty important. So the EU, basically, just under 50% of UK exports go to the EU. It has been higher, so that share has been falling. So it's just under 50%. Works out to be something like 13% of GDP. And again, one of the interesting things here is the fact that, as you would expect, given the EU is a lot larger in size than the UK itself, that the trade going the other way as a share of the European Union, exports of Europe to the UK are important, but not as important. So about 8% of EU exports go to the UK versus say 50% of UK exports going to the EU. But what's interesting is that if you strip out intra-EU trade, so what percent of exports of the EU region to countries outside of the EU, if you include the UK as a country outside of the EU, it's something like 18%, or almost 1/5 of exports of EU countries outside of the EU. So on that measure, it's still pretty significant. But you're fair in saying, obviously, given the closeness of the EU and the size of that market to the UK, you would expect it to be a fairly important export destination, and the UK not to be as important to the EU. So that's why the bargaining position, and the EU seems to be able to have a pretty tough bargaining position with the UK at the moment. It probably feels it can weather any downturn in the economy.
Okay. Now, you did mention that the date of Brexit was the 31st of October, and there's just a comment here about Scotland. Haven't mentioned Scotland at all. And what's the risk of an independent Scotland, Alistair?
Oh, look, it's recently come up in the news again. Senior political figures in Scotland being open to Scottish independence. I know Nicola Sturgeon has been fighting for it for a while. In my opinion, the risks at the moment are reasonably low. That one way to go about it, they'd be looking for another referendum. I think if anyone's learned anything from Brexit, is not many of these parties would be open to going through the referendum route. Again, there's been a lot of blood spilled on both sides of the party politically. Jeremy Corbyn of the Labour Party is keeping very stum in terms of opinions around allowing that to happen. My feeling is that it really wouldn't be in their interest to do it. Time will tell, but it doesn't seem to be a major risk at the moment. Not to say that there isn't the chance of that happening.
And what is the minimum to invest? And is this listed on the ASX? You just wanted to shoot back there, Alistair. This one's probably for you.
Yeah, absolutely. So the minimum amount you need to invest is a single unit. Typically, the unit price is very low. It's available to be traded, on the ASX through the trading day there. In terms of dollar values,
I think some online brokers have a minimum of 500.
Correct.
An initial minimum of $500 to invest, and then after that, you are clear. Okay, so just a question about the companies on the index, and just asking about, and I know we touched on it before, about the percentage of earnings from the UK. But if you just wanted to go back to and the sort of names that you're only able to access on the FTSE 100, Alistair.
Yes, absolutely. So some of those key names, as we mentioned, HSBC, a globally recognised bank, one of the largest in the world, only accessible through here, particularly in Australia. Shell, another one that these are household names that people will most likely come into contact on a daily basis. BP, British Petroleum, again in the energy space, you're looking at massive global names here. Moving further down the line to other areas, I mean, Diageo, one of the largest owners of alcohol brands in the world there. So very, very widely owned. Guinness, whilst being an Irish company, I think their largest consumer base is in Nigeria. So you're getting huge global names, GlaxoSmithKline, Rio Tinto makes an appearance in there as well. So yes, these are not just European-focused companies, these are not just UK-focused companies where their revenues are coming from.
Okay, great. You did speak about income from the index. Are any dividends subject to any UK withholding tax? And how often does the fund distribute?
Yep. So I mean, like anything, the fund does have to invest in UK stocks. So at a fund level, there would be UK taxes applied. The fund is Australian domiciled though. So on your end, it's like investing in an Australian company. There's no excess paperwork there, but income is coming from UK stocks at a fund level. In terms of distribution frequency, we're looking at semi-annually, so twice a year.
Okay, great. And now sort of one probably back to you, David. A little bit more detail about the Irish backstop. So what does this actually mean? How do they resolve it? Do they?
Very good question. Look, it was really a fudge. You know, at the end of the day, there was effectively the deal that was agreed between Theresa May's government and the EU, and basically the bill that was put to Parliament and rejected several times, effectively kept Northern Ireland, and my understanding the UK, effectively within the EU customs union for the foreseeable future. And that was the only way in which you could still allow the free flow of goods between the Republic of Ireland and Northern Ireland, because they'd still be in the same customs union. And so the only way to achieve that no physical borders was to effectively keep the EU within that you know, similar customs arrangements. Now the problem for the UK was that would then limit their ability to strike out and do new trade deals with other countries, which is, I guess, seen as a big positive was seen as a positive at least of leaving the EU, and the way in which the agreement was struck was both sides would need to agree to end the backstop or end that agreement for it to come into force. And so, you know, the argument was that the EU could continue to hold the UK hostage and be part of the customs union for the foreseeable future, because they could just continue to refuse to let the UK leave. So, you know, that's the detail. That's essentially it. It's a Brexit, you know, a Brexit without really being a Brexit, essentially, in terms of customs and trade restrictions. And that was the big sticking point. And so, you know, a hard Brexit, I guess at the end of the day, a hard Brexit would mean that Northern Ireland would be outside of the EU, and the Irish Republic would be inside the EU. So, you know, physical borders would need to be imposed, and customs checks that would be one implication of a hard Brexit. It seems to me that what everyone didn't want to see is those physical borders within Ireland being reimposed. So so hopefully that gives a bit more colour to that issue.
Yeah, absolutely. One of the bigger issues. So, and just a sort of general question about investing in ETFs and I guess the fees. Alistair, how are the fees charged for those sort of unfamiliar? And for example, on $1,000 investment.
Yes, so the fees actually accrue out of the net asset value of the fund on a daily basis. So this fund's got a management fee of 0.45%. So for $1,000 in a year, you'd be paying $4.50. But if that you're not paying out a subscription or a fee like that, it automatically comes out of fund performance. Any change in unit price and dividends will have already had the fee taken off. There was one comment around the fee being relatively high compared to something like, say, our A200 ETF, which is 7 basis points. In this area, obviously, being in the UK, on the other side of the world with time differences, it does take more to manage a portfolio of these stocks compared to a broad Australian one. It's also highly competitive and very comparable to other European and international ETFs here across the globe as well.
Excellent. Thank you for that. So with that, I think we will wrap up today. Thank you very much for your attendance, and just a few reminders. Please keep in touch. Jump onto our website. Always an opportunity to subscribe to Bassanese Bites, which is David's Monday morning snapshot of the economic week ahead. There's also plenty of insight from the team available on our website. And launching tomorrow, we are very, very pleased to speak more about our India quality ETF. So keep an eye out for that. Thank you so much for joining us. Thank you, Alistair. Thank you, David.
Thank you.
Thank you.
Thank you very much.
See you next time.